It is 4:15 p.m. in New York. The closing bell has rung, the orders have matched, and, well, the dust is settling on what was a deceptively violent session. This is the deep dive, and we are looking at the scoreboard immediately. The S&P 500 closed at 6,976.44. That's down 0.8%. The Nasdaq 100 was the absolute pain trade of the day, finishing at 21,342.10, shedding 1.4%. And the Dow Jones Industrial Average closed at 49,215.12, down just 0.3%.
And that Dow number is doing a lot of heavy lifting to mask the damage, isn't it? It's practically gaslighting the rest of the market.
It absolutely is, because if you just glanced at the closing print, you'd think, okay, a mild pullback, nothing to see here, just a little digestion, but you have to look at the intraday action. The Dow actually hit a fresh all-time high of 49,633 mid-session. It broke out, it looked like it was going to run, and then it absolutely puked into the close.
Right. We have to label this session exactly what it was. This was a trend day down and a classic distribution day. This wasn't just retail taking some profits off the table to buy a new boat. This was a rejection of the highs. When you make a new high and close near the lows, that is the market telling you that buyers ran out of ammunition.
That reversal was nasty.
Mm-hmm.
So let's unpack the narrative here, because the context matters. We walked in this morning, Palantir had crushed earnings, the pre-market looked juicy, the Dow makes a new high, and then the rug gets pulled. What is the diagnosis here? Was this just a head fake?
It was a textbook head fake, and honestly, a fade the rally session for the institutional playbook. You have to look at the catalyst that stacked up against the bulls right around that 10:30 a.m. liquidity window. It wasn't just one thing, it was a trifecta. First, you had the geopolitical wire reports of that U.S.-Iran drone engagement. Now, we know these headlines often get bought back up later, but in the moment, that spooks the algos.
Sure, it's an immediate risk-off trigger. The machines read drone, Iran, U.S., and they hit the bid before a human can even read the headline.
Exactly. But then you layer on the Fed component. Kevin Warsh, who everyone is pegging as the successor to the chair, came out with a noticeably hawkish tone today. The market is sniffing out that the easy money pivot might be further away than the bond market is currently pricing. That puts a hard cap on valuations. But the real story, the one that drove the Nasdaq down 1.4%, is this concept of AI exhaustion.
We've been hearing this buzzword for months, but today it felt tangible. It felt like the market finally said, show me the money.
It felt real because the market is starting to aggressively question the ROI on this massive CapEx spending. We are seeing beat and raise quarters like Palantir, which we'll get to, but they aren't lifting the index anymore. When good news stops pushing stocks up, that is a massive signal that the buyer pool is exhausted. It's simple physics. If you push on a door and it doesn't open, someone is holding it shut on the other side.
That's the sell the news dynamic kicking in. You could see it in the flows, right? The rotation was glaring.
Pronounced rebalancing flows. We saw a distinct shift out of the Magnificent Seven, the growth engine, and straight into defensive cyclicals and the real economy. We're talking healthcare taking the top spot today as a refuge. Investors are hiding in earnings they can touch and feel, not just AI dreams. They want cash flow now, not in 2030.
An energy lag, too, which is interesting given the geopolitical headline. Usually a drone strike sends crude flying.
Yeah, energy lagging there was tied more to softening global demand forecasts and the dollar stabilizing. It tells you the market is worried about growth, not just supply shocks. But the big picture takeaway on the narrative is that the buy-the-dip muscle memory we've relied on for 2 years, it's being tested. The market feels slippery here. It's not catching a bid at the usual spots.
Slippery is a good word for it. And I want to grill into the internals because that's where you see just how slippery it is. You mentioned this was a distribution day. I'm looking at the volume numbers to confirm that, and they are telling a pretty clear story.
What are you seeing on the tape?
Volume on the SPY and QQQ clocked in at 112% of the 30-day average.
There it is. That's the confirmation.
That is statistically significant. If we were down 1.4% on light volume, I'd say, okay, buyers went to lunch, no one was home.
Yeah.
But 112% volume on a down day, that validates the move. This is a high conviction distribution.
Exactly. This wasn't retail panicking in their brokerage apps. Retail doesn't move the volume needle like that. This was institutional exit liquidity. The big money used that morning gap up the optimism around Palantir to sell into strength. That is distribution pattern 101. Institutions need volume to get out of massive positions without crashing the price immediately. They use the morning hype to find that liquidity. They essentially handed the bag to the retail crowd chasing the open.
And the breadth supports that view. The advanced decline ratio hovered right near 1.2. For every stock that went up, 2 went down. It wasn't a total washout. It wasn't 1.10, but it was heavy.
It's the specific pockets of rot that concern me. You mentioned the Mag 7 earlier. Look at Microsoft and Nvidia, both shedding nearly 3%. When the generals retreat, the troops get nervous. You can't have a sustainable rally when your trillion-dollar anchors are down 3%. Those names hold up the indices. If they crack, the index math just doesn't work for the bulls.
And speaking of nervous troops, let's talk about the VIX. The fear gauge. It didn't just tick up, it woke up.
It surged above 20. And this is where we need to pause, because for the listener who just watches the stock price, that number 20 on the VIX might just look like a random statistic. But it matters.
Why is that 20 level so critical mechanically?
It is a critical mechanical threshold. It's not just a psychological fear number. There are massive systematic funds, volatility targeting funds, that base their leverage on the VIX. When the VIX is low, like 12 or 13, their models tell them it's safe to lever up, they buy more equities. But when it crosses 20, their risk models start flashing red.
So it triggers a forced action.
Precisely. It changes the math from hedging a portfolio to liquidating positions to reduce risk. If we stay above 20, that selling becomes mechanical and blind to fundamentals. They aren't selling because they hate the earnings. They're selling because a math equation told them their volatility exposure is too high.
That creates a feedback loop. Selling begets volatility, which begets more selling. And that ties back to that divergence you spotted. The Dow hitting an all-time high, while the Nasdaq couldn't even challenge its pivots.
That is the bearish divergence screaming at us. Historically, when blue chips, the Dow names, lead and make new highs while the growth generals retreat, it signals a late-stage cycle move. It's often a bull trap. It sucks people in on the headline Dow hits record, while the actual engine of the market, technology and growth, is stalling out. It's like the band playing on the deck of the Titanic. It looks nice, but the ship is taking on water below.
It's the classic generals are shot and the defensive line is holding the fort scenario.
And the fort rarely holds for long without the generals.
Let's move to the crime scene. We call this segment the gap and crap because there were some absolute graveyard trades today. If you were chasing momentum at the open, you probably got hurt.
Oh, there are some heartbreakers today. The kind of moves that ruin a month of P&L in about 30 minutes.
The poster child has to be SanDisk, SNDK.
Rough. Just brutal.
I mean, look at the psychology here. They report earnings. The stock opens up 20%. If you bought that open thinking, here comes the breakout, I'm getting in on the next leg up, you were destroyed. It erased nearly the entire gain by the bell.
That is the definition of exhaustion. When a stock delivers good news, gaps up, and sellers immediately slam it back to flat, that tells you the market believes the good news is fully priced in. There is no incremental buyer left. Everyone who wanted to buy SanDisk bought it before the earnings. The gap up was just an opportunity for them to ring the register. It's a classic liquidity exit.
To the brutal lesson in liquidity. And then you had Novo Nordisk, NVO. That wasn't a reversal. That was just a capitulation.
Down 15%.
Weak 2026 guidance.
And that dragged the whole healthcare sector, even though healthcare was technically the refuge today. It just shows that even the defensive names have execution risk. When you are priced for perfection and you guide down 2 years out, the market has no patience for that right now. In this environment, you miss by a penny or lower guidance by a fraction, and you get taken out back.
But we have to talk about the outlier. The one name that actually did what it was supposed to do.
Palantir. The only thing that worked.
PLTR, gapped up 7% on the earnings beat. Now, usually on a day like today where the Nasdaq is down 1.4%, you'd expect a high beta name like Palantir to fade with the market. You'd expect it to fill that gap.
Right. The gravity of the broad market usually pulls everything down, especially high valuation tech.
But it didn't. It drifted lower, sure, but it closed up 6.5%.
That is what we call relative strength. In a sea of red, Palantir held its ground. It defied the tech bloodbath.
What does that tell you about where the money is going?
It tells me that institutions are still willing to accumulate AI exposure, but they are becoming incredibly selective. They aren't buying the basket anymore. They aren't just buying the sector ETF. They are buying the specific winner that just proved it has the growth. Palantir is the relative strength king right now. They proved the use case. They showed the revenue, so they get the bid.
So that's one to keep on the radar. It's showing us where the institutional bid is actually sitting. And then, just to round out the specifics, after the bell we had AMD.
Another chip name.
They reported the options market was pricing in an 8% move.
Big expectations.
We're watching that $228 support level closely. In this environment, with the VIX above 20, if AMD gaps down and breaks $228.
It becomes a gap and trap or just a straight flush. If $228 fails, you're looking at a quick trip to $215. The market is in a show-me mood, If AMD doesn't blow the doors off, it gets punished. There is no benefit of the doubt right now. Investors aren't paying for next quarter anymore, they're paying for right now.
Okay, so that's the damage report. We know why it happened. We know who got hurt. Now let's turn the page to Wednesday morning, the strategy. What is the game plan for the listener trying to navigate this chop?
We have a very specific setup forming. I call it the 6,800 liquidity grab.
Okay, walk us through the levels. Why 6,800?
So we closed the S&P 500 at 6,976. But the key level we lost today, and this is technical, but stick with me, was 6,962.
The 6,962 number, that's a zero gamma flip, right?
Correct. And for those who don't stare at gamma profiles all day, here's what that means in plain English. Market makers, the dealers who facilitate our trades, have to hedge their books. Above that level, their hedging stabilizes the market. They buy when it drops, sell when it rallies. It suppresses volatility.
But below the flip level?
Below 6,962, the dealers are in a short gamma position. That means they have to sell futures when the market drops to hedge themselves. Their selling creates more selling. It greases the skids. It creates that slippery floor we talked about.
So if we are below 6,962, we expect momentum to the downside to accelerate because the dealers are essentially pouring gasoline on the fire.
Exactly. They are chasing the market down. So, looking at tomorrow, if we open below 6,962, the target is 6,800.
And what is that 6,800?
That is the structural put wall. That is where the massive open interest for put options sits.
So that acts as a magnet.
It acts as a magnet and then usually a trampoline. The market gets drawn to it because that's where the liquidity is.
So what's the trade execution here?
The trade is, don't fight the tape at the open. We have a trend day down today. Statistically, there is a 65% probability of continuation into the next morning. We call it the follow-through.
So expect a weak open?
Expect a weak open. Watch us flush down. Do not try to be a hero at 6,900. Do not try to catch the night halfway down. Wait for the flush into 6,800.
And when we hit 6,800?
That is where you buy. Once the weak hands are cleared out and we hit that wall, dealers stop selling and start buying to cover. You often see a mechanical V-bottom reversal right off that wall.
So patience is the alpha here. Let the flush happen. Buy the wall at 6,800.
Precisely. It's a defined risk trade. If 6,800 snaps, you get out immediately. But the odds favor a bounce there. It's about playing the dealer positioning.
And for a day two play on the long side, is there anything worth looking at if we do get that bounce?
Watch Palantir.
Still.
Yeah.
Even after the gap.
Yes. If it holds Tuesday's midpoint, if it doesn't give back those gains, it is a day too long. It shows that institutions are accumulating. In a market where everything else is being sold, you go where the strength is. You want to own the stock that refused to go down when the market crashed. That divergence is your signal.
It's the only boat floating, so you might as well get on it.
Exactly. Don't overcomplicate it. Follow the flow.
All right, let's wrap this up. We have a catalyst tomorrow morning, too, that could disrupt all of this math. The silence breaks.
ADP employment print.
That's going to set the tone before the bell even rings. If that number comes in hot, Fed fears ramp up because it means the economy is too strong for cuts. If it comes in cold, recession fears ramp up.
It's a bad news is bad news and good news is bad news environment right now. The market is looking for a reason to sell. It's looking for a reason to correct valuations.
Fantastic. Just how we like it. Chaos creates opportunity, right?
Keeps us employed and keeps the premium high.
So the bottom line for the listener.
The market is neutral to heavy. That's the sentiment. Watch the 6,950 level on the upside. If we can't reclaim that, we are heavy. And watch that 6,800 wall on the downside. That's your battlefield.
Stay sharp. Don't catch a falling knife until it hits the floor. Watch the 6,800 wall. See you at the opening bell.